My play is Tesla. They were given the boot today. Not that lock on your tire for too many tickets, but they've actually been kicked out of the S&P 500's ESG index. The S&P explained the decision in a blog post saying Tesla's, quote, lack of low-carbon strategy, codes of business conduct, along with racism and poor working conditions reported at Tesla's factory in Fremont impacted their score.
There's a lot to unpack there. Tesla, the world's largest manufacturer of electric vehicles, has been removed from an investment fund created specifically to reward companies rated highly for their commitment to environmental and social causes. So what is ESG? It stands for Environmental, Social, and Governance. It's a system of rating companies based on many non-financial factors, or sometimes what I call politically motivated investment schemes. It goes back a few decades, starting with different terminology like social responsibility investing, which over time merged into ESG. ESG is a challenging issue. Groups with little transparency or accountability are coming in and giving companies scores or judging how responsible they are with respect to ESG. But no one really knows what ESG means. Ask 100 people and you'll get 100 different answers. It's really difficult to define. Unfortunately, the progressive left uses ESG principles as a political weapon against anyone who doesn't stand up to their Green New Deal and a big government takeover of people's livelihoods. If there were a more neutral definition of ESG, there might be some interesting things that you could pull out of it, such as best practices around governance that companies could use, which could be beneficial in the long run. However, ESG has gotten so weaponized by the political left today that you don't know what it means. The new ALEC model policy to address politically driven investments within public pensions is only a few weeks old. It's something that our legislators have brought to us in response to the proliferation of politics entering the world of fiduciary duty in public pensions. It basically puts into law real protection to say that people cannot put their political views ahead of long-term investment returns within state pension plans. Pension systems across the country, especially in progressive states like New York, Illinois, and California, are hundreds of billions of dollars, if not trillions, underfunded. Ultimately, what this means is higher taxes for all of us, and in some cases, lower benefits for workers. To keep these pension plans above water, we need to have financial practices similar to real fiduciary rules in the private sector. And that's what our model policy accomplishes. This isn't rocket science, it's basic economics 101. If people put their political views ahead of long-term investment returns for pensioners or workers, there need to be penalties and there need to be real protections in state law. That's exactly what this new piece of model legislation does.